Hey folks, welcome to Quantsapp. Welcome back to yet another video. So today we will learn about the calendar spread option trading strategy, wherein we will first understand what is the mechanism and what are the basics, what are the grounds of this strategy. Wherein let's say if I want to go ahead and deploy a calendar spread tomorrow, why should I do it in the first very place? And then we will understand the sweet spots of actually deploying a calendar spread. So do check out the video till the very end. So to start off with, let's understand what is a calendar spread. So let me just take you to Architect. You can use the search panel and just search for Architect. The link of the analytic will be there in the description box below. So let me quickly give you an heads up what Architect actually does. Architect will help you in analyzing any of your option trading strategy, be it a bull call spread, be it a calendar spread, be it a simple plain vanilla long call. It will help you in analyzing your option trading strategy. So calendar spread is first of all a oscillating strategy wherein it will yield you returns if the market remains range bound. If there is no major movement happening in the market, the calendar spread will give you the most money. So you can make calendar spread using put option or call option. Any of them, most of there would not be a major difference as such, but you can consider making calendar spreads from call or as well as put options. So now just understand the mechanism of this strategy and what is happening out here. So what has happened is you are selling 19,300 strike price call option, and at the same time you are buying 19,300 strike price call option. You are buying 19,300 and you are selling 19,300. So you would say that this is a square of trade, right? You are creating an opposite position. But over here, if you see, we have bought one leg and we have sold the other leg, plus the expiry. First one is of 21st August expiry and the other one is of 31st August expiry. So now why we are doing something like this is because we all know that theta is something what will affect our option premium. So what is theta? Theta is trying to show us how much our option premium will get decayed due to passage of one trading session or one day. Okay, even the theta will decay even on the days when the market is not working, right? When the market is off. So it doesn't matter if the market is open or closed, the theta will do its job, it will decay the option premium. Okay. Now, will it decay the option premium in same quantum for all the expiries? No. It depends how closer I am to the expiry, and accordingly the theta will adjust its pace. What I mean is, let's say if this is the expiry point, this is the expiry date, more far off I am from the expiry, lesser the theta decay will be. More closer I am to the expiry date, more higher the theta decay will be. So just check this entire thing out, wherein we have sold 24th August call and we have bought 31st August call. So to check the Greeks, I just need to scroll it down a bit. Now for 24th August expiry, just see the theta. What is the theta? Theta is 362 rupees positive. Now why it is positive? Because I have sold that particular leg. Okay. Now on the other hand, I have also bought 19,300 strike price call. Over here, my theta is negative. Obviously, if I am buying option, I will be net theta negative. So over here, I am buying option which is 19,300 but of 31st August. So I'm paying theta of 257 rupees. But still, if you calculate and if you do the net sum, it is a theta positive strategy of 100 rupees roughly. Very small figure. I will tell you how can we improve this a bit. But now, if you just imagine in being a strategy something like this, which is giving you no defined loss, if you just check the payoff out now, so you will see that the losses at any given point is capped, right? You will not see an undefined loss scenario, something like straddle or strangle. You will not see that happening on a calendar spread. So that is the best part, that you can have a sound sleep when you are doing something like a calendar spread. Coming to the second part, it is giving you a decent profit as well, which is 1,400, which is all good. We will try to obviously amplify that, but as of now, you are getting a decent return. Now, the strategy is also a theta positive strategy, wherein if nothing happens in the market remains where it is, you will make money in this option trading strategy. So this is calendar spread. Now, how it is making you money? Because the theta of the current expiry is decaying a bit faster, and the expiry which is far away the theta is decaying slower, and the net differential is what is paying you off. Another that apart from this, the other aspects of the strategy is that you will not bear a gamma risk, which you do in short straddles and strangles, and eventually the strategy is a vega positive strategy. That means even if the IVs go up, still this strategy will yield you returns. Now, at the very first place, I think we all understood that what is a calendar spread and why, what are the grounds, what are the basics of this option strategy, what are the foundations. Now, coming to when exactly I will go ahead and prefer to do this strategies when I'm getting a bit closer to the expiry. That's number one. Number two scenario is whenever I expect that there might be a possible jump in implied volatility and I'm expecting that there will not be a big movement happening in the market, that is the time I will consider doing something like a calendar spread. Imagine that just check this out. Okay, this is T plus and PNL, by the way. Just check this out. If I am expecting a 10% jump in volatility, in implied volatility, now you will see that this payoff, T plus N payoff, that has shifted a bit upwards. That is trying to show you that jump in IV will help a calendar spread. Now this was from the call side. Now let's try to understand it from the put side as well. It will work the same. I'm just trying to show you why it is. I prefer put side calendar spreads much more because of the implied volatilities. So let's say calendar put. Now if you see, the reward to risk has got slightly better, and if you see at the peak we are making expiry pay, we are making roughly around 2,700 rupees. So the reason doing a calendar on the put side would be more attractive is because of the implied volatilities on the put side. If you just open an option chain, you will generally see put side implied volatilities being relatively higher as compared to call. It will not be a very big difference, but still you will see a relative difference, which is the put side IVs will be relatively higher. So you'll get more premium on the put side, and eventually this strategy will give you more, and this will be more attractive is what I meant to say when you do it on the put side. It will work exactly the same, except this will give you much more better reward to risk if you do it on the put side. Now there comes a bit of tweak in this strategy. How can we tweak around it with the directional bias that we have? Let's say I'm anticipating Nifty by end of this weekly expiry, which is 24th August expiry, Nifty to achieve somewhere about, let's say, 19,500, 19,600. So wherever my target is, I will create a calendar spread of that strike. Meaning, if my target is 19,300, I will create a calendar spread of 19,300. Buy, sell the current one and buy the ahead expiry of the same strike price. Okay. If my expectation is that the market might go to 19,600, I will create a calendar spread at 19,600. 19,600 current expiry sell, next expiry buy to hedge it and still be net positive on the theta decay. So the peak will appear wherever you have created the calendar. Let me just show you. So let's say this 500, and this is, by the way, diagonal calendar, which is much more of a directional strategy. I'm trying to show you how can you be non-directional, and still, basically the idea is you will create a calendar ahead only. That is the idea. So see, this is how it will look. Now the peak profit will happen at the point where you have created this calendar. Calendar spread has been one of those strategies which can help you in generating consistent returns. However, big moves in the market might you know put you in trouble, but still it will not be a big of a risk, because the thing is you are defined at all the given points, right? Your losses are known. You're not going to face undefined losses, market going anywhere. And if market doesn't go anywhere, still the strategy makes a lot of sense. And apart from that, do check out Architect tool and analyze more of such option trading strategies at absolutely no cost. And do check out the link. It would be there in the description box below, and also it would be there in iCard.